In this video, I'm going to tell you what your tax preparer would never tell you. So when it comes to tax preparation, I'm not going to really talk about the full tax return, but especially when the tax preparer start giving you advice on what investment account to have. And almost all tax preparer, they would want to save you some taxable income, and they would advise you to put in a traditional IRA account. The one thing that if you start making a contribution in a tax-deferred vehicle, such as a traditional IRA account, the one thing you want to be sure and understand is that you may be saving taxes of last year's income. But at some point, that contribution that you made into a tax-deferred vehicle, you're going to be paying taxes at it at some point. And you may think, well, that problem is going to be later, 20 years down the road. Now, by chance, let's say that you put it in an account that is invested and it has been growing over time, let's say in a growth type of investments like a mutual fund or an ETF, and you've gained some rate of returns over the course of 20 years. Now that contribution then has grown significantly over time period, and now you're going to take the distribution out of that account, and at that point you're going to be subject to a much larger amount of taxes on that amount. Now, you may be in a lower tax bracket, because that is what the tax preparer will tell everybody, that you want to save at this point paying taxes on a portion when you're in the higher tax bracket, and hopefully when you're retired you're in a lower tax bracket, and then at that point you pay less taxes on that amount. I wish to tell you that if that is really applicable to everybody's situation. I've been doing this for a very long time, and most people really, when they retire, they really don't want to go to a much lower tax bracket. And if you actually go to a lower tax bracket, you are actually paying still more taxes over the quantity of the deposit you've made over time period. So it is not necessarily that you are saving the long term. It is that you basically are kicking the can further down the road, and at that point possibly you're going to be paying more taxes over the same amount of the contributions you made, because that contribution now have grown over time period. So let's say that you make a contribution of $6,500 today, and then let's just say over 10 years time that contribution now is double the amount. Let's just say an example, $13,000, and now you have to make the contribution out. Whenever you do it, at some point now you have to pay taxes over that whole amount, which has now grown in that sense. So that's the one thing that a lot of tax preparers do not go into details, because that leads to the next point, is because they are more looking at a last year's situation, how they can help you to reduce your last year's taxes. And so a tax preparer is not necessarily does tax planning, which is a lot of people are confused with thinking that their tax preparer is helping them with tax planning. Tax planning is looking ahead, is looking 10, 15, 20 years in front of you to look at your total taxable amounts that you have that you will be subject to taxes, and trying to reduce that amount. A tax preparer just looks at what happened last year and is going to give you all of the tips possible to reduce last year's taxation. Now, the thing is that these tax preparers will be very much inclined to always trying to tell you to put money in a tax deductible account like an IRA account. And the reason why is because they want to look good in front of you. They want to be able to do a very good job so that you can return next year again to them. But that does not actually help you in the long term. And that's why I tell most of my clients, just bite in the lemon, bite through it right now, pay the taxes right now, and that way you'll be able to make an after-tax contribution, and therefore you're able to, for the rest of the account's life, when it's applicable, of course, take out money and not having to worry about future taxes and whatnot. But again, this isn't a case-by-case situation. You still have to consult with a professional to see if having a money per se in a Roth account contribution will help you long-term or not. Another point that is often not discussed is that even if you make a $6,500 contribution in a IRA account, it does not reduce your taxable income dollar per dollar. And so that is what most confusing or most disappointing part is, to understand that when you make that contribution, $6,500, it doesn't reduce it. So it's not a dollar to dollar combination. So there's not a huge advantage. At that point, you can really consider, if I make a $6,500 contribution to an IRA, how much really am I saving on my taxable income? At that point, just the fact that you may make the contribution in a Roth account is be better off. Now, if your concern is not really to save for retirement and just reduce your taxes, then you do what is most suitable for you. All in all, you want to understand that a tax preparer works every single year for you and trying to earn his and her business from you every single year. A financial advisor or a professional that in the industry is trying to build a more long-term relationship, a more over the years, over and over time period. So the incentives for somebody like me to work with a client, I want the client, and I'm expecting the client to be with me for the next 20, 25 years. I want to be able to see what we have done and prepare for come to fruition. A tax preparer may want somebody to keep coming back, but they're not dealing with the whole aspect of somebody's finances. They're just dealing with a portion of the person's finances. So take those things into account when you do your tax preparation. That may help you to understand better what choices you have to make or want to make. If you have questions that you wanted to talk about with somebody like me, please do not hesitate. I'll leave my contact information below. Thank you for watching.